Hi everyone, welcome back to another video. Today we are going to be looking at IGCSE Economics Chapter 38, Foreign Exchange Rate. Now this is arguably the most confusing chapter in all of economics. So let's get started and understand this chapter completely. First of all, we need to know what exchange rate in its true essence is. So the definition of it is basically the value, the value or price, the value or price of one currency in terms of another currency. For example, US dollars in terms of Ghana cedis. So if I said I had $1, which means 15 Ghana cedis, that would basically tell you that $2 means 30 cedis. So this is the value of, let's say, US dollars in terms of Ghana cedis. Now the values that I used here, they are not exact, just random values that I took, okay? Now, when you come to exchange rate systems, right, you have two types of systems. You have the floating exchange rate system and you have the fixed exchange rate system. Now, the floating exchange rate system is determined by the market forces of demand and supply, whereas the fixed exchange rate system is determined by the government through the central bank. Now, why through the central bank? Because this is a monetary policy or a monetary thing that's going to happen. And it's not something the government directly controls. It's controlled by the central bank through the government. Okay. Now, in a floating exchange rate system, we have two things. We have appreciation and we have depreciation. Appreciation is the increase in the value of a floating exchange rate, okay? And depreciation is the fall in the value of a floating exchange rate. So you just need to remember increase or rise and fall or decrease in the value of a just whatever system you're talking about. Now, that's for floating exchange rate system. When you come to fixed exchange rate system, you have revaluation over here. It's, as you'll notice, it's no longer appreciation, it's revaluation, and here becomes devaluation. Now, the definition is basically the same, except you change the system which you're talking about. So rise in the value of a fixed exchange rate system, and this is a fall in the value of a fixed exchange rate system. Now, note that appreciation and revaluation have the same effect, but they are in different exchange rate systems. Okay, this one is in the floating exchange rate system, and this one is in the fixed exchange rate system. Right. Now we need to know the causes of appreciation. Now, causes of appreciation could be caused by increase in the quality of goods. Now, why is that? When a country's goods become better in quality, foreigners would want to buy more of them, right? Now, to buy these goods, they need to exchange their currency for the local currency so that they can buy the goods in the local currency. This would basically increase the demand for the local currency, which would essentially lead to appreciation. Then we could also have high interest rates. Higher interest rates attract foreign investors who want to earn more from savings and investment, like bonds. These investors convert their money into the local currency to invest. In order for them to convert to the local currency, they need to demand for it, right? If there's more demand, that will lead to appreciation. Then FDI. FDI stands for foreign direct investments. Now, FDI is when foreign companies invest in businesses or infrastructure in another country. Okay, so FDI is basically businesses going to different countries to set up manufacturing so that they can produce or work their businesses over there. Now, they need to convert their currency into the local one to invest, right? Like, for example, if you are in India and you are a business in, let's say, I don't know, Ghana maybe, and you want to invest in India, you possibly can't use Ghana cedis to invest in India, right? You need to convert to rupees, which will increase the demand for rupees, which will lead to the appreciation so that the business can invest in India, right? Now, when remittances need to be sent, remittances are money sent back to the home by citizens working abroad. Okay, when they send money, it's usually converted into the local currency. If it's converted into the local currency, the inflow boosts the demand. So you in order for you to convert, you need to demand, right? If you're more demanding, then that will lead to appreciation, basically. Businesses wanting to send investment back home, the same thing as remittances. Okay, profits earned abroad may be sent back to the company's home country. This requires converting from foreign earnings into domestic currency. As this happens on a large scale, it pushes the value of the currency up drastic more, and it has more effect than the remittances, right? Then when we come to causes of depreciation, decrease in the demand for exports, okay? If a country's goods are no longer in demand, maybe due to poor quality or global competition, fewer people will want to buy from them. Now, if fewer people want to buy from them, their demand is going to fall, right? And lower demand will basically cause depreciation. Low interest rates. If a country is offering low interest rate, then foreign investors will look for different countries with better interest rates to invest in. So they will withdraw their investments and convert the currency back to their own, or to the currency that they want, or to the country's currency that they want to invest in. Now this will decrease the demand for the local currency and increase the supply of the local currency, which will lead to depreciation. Now, low FDI, which again stands for foreign direct investment. If foreign direct investors lose interest in investing in the country, maybe due to risk, low returns, instability, maybe due to war, disease, any reason, the FDI drops. Fewer foreign investors means less currency conversion into the local currency, decreased demand leading to depreciation. High flow of imports. If a country imports more than it exports, it constantly buys foreign currency to pay for the goods. That means that the country is demanding more of a different country than that country is demanding for your country. This increases the supply of the local currency in the forex market, which leads to depreciation. Now, we also have outflow of remittances. If a foreign workers are sending money out of the country, local currency is being sold to buy the foreign currency. This raises the supply of the local currency, which in turn leads to depreciation. Now, this is a quick summary table that you could take a screenshot of or go through. I'm not going to go through all of them, but yeah. Now we have causes of exchange rate speculation. Now it's the same thing. You see, causes and causes, but these are just other ones more. Okay, I'm not going to go into detail because it's basically something you can read in the textbook as well. But okay, let's see. Changes in demand for exports and changes in demand for imports. So you know that the demand and supply are the one that are going to determine the fluctuations in the exchange rate, because you know that it's a floating exchange rate system which is determined by the market forces. Prices and inflation, FDI, which we talked about, speculation. Okay, now I'll explain these two things, and they are basically interrelated. Okay, so speculation is anticipation that something will change. Now, if an investor is speculating that maybe there will be higher interest rates in one country, then they will buy more of the local currency to invest in it, which will increase the demand and lead to depreciation. But if they speculate that the currency is going to depreciate, or the interest rates are going to lower, then they will sell the currency, which would increase the supply of the currency, which will lead to depreciation, right? And hot flows are basically people keeping and speculating in search of a higher interest rate. Okay. Now, the questions for this chapter is mostly going to be on effects. Now, I say mostly because I've seen a lot of questions on them, but that doesn't mean that you shouldn't learn the other ones. I have seen equally questions on other small topics from this chapter as well. Now, when a country's exchange rate system depreciates, what happens? Now, when it depreciates, your exports becomes cheaper, which could lead to quality of your exports, which increasing, which could increase your international competitiveness. Now, why does this happen? Because you see depreciation, right? That means that the people in the foreign country can now buy your goods for a cheaper price, which is why your exports become cheaper. But you buying the same thing from them becomes more expensive because your value of your currency has decreased. So, which is why imports become more expensive, and the imports or quantity imported decreases. Now, if exports revenue is greater than import expenditure, this helps stabilize current account of balance of payment, which could lead to economic growth, which could lead to employment, and you could basically use this formula to talk more about that. Now, which could also cause imported inflation of raw materials, because you're now going to export more, right? In order for you to manufacture the exporting goods and everything, you first need to get the raw materials. If these raw materials are being imported, then since the value of imports is going to, like, the prices of imports are going to increase, that could lead to imported inflation, which could increase the price of your exports. Now, when a country's exchange rate system depreciates, this is basically the opposite of whatever we talked with over there. Okay, so if it depreciates, that means this will decrease, right? This will decrease the aggregate demand, and this is basically the same as economic growth. Now, since it's the opposite, imports will now become cheaper, exports become more expensive, reducing your international competitors and causing unemployment. Uh, yeah. Now, if your import expenditure is greater than your export revenue, this could deteriorate the current account of balance of payment, and this could lead to increase in consumers' purchasing power. Right. Last page, okay? Now, fixed exchange rate system is when the government is fixing the exchange rate between a range or a margin. For example, $1 could be between 14 to 16 Ghana cedis, or $1 could be 15 Ghana cedis. So it's not a particular fixed value. It can be a fixed value or it can be a range. All right. Now you need to know the advantages and disadvantages, because I have definitely seen questions on this as well before. So advantages of a floating exchange rate system is that there's no government intervention. It doesn't require government reserves. So government can use those for macroeconomic aims. Disadvantages, however, is that it's difficult for firms to plan because of the unpredictability with it. If people speculate wrong, they could also lose money, right? Now, so the advantages here basically become the disadvantages here, and disadvantages here become the advantages over here, right? So better for firms to plan, so reduces uncertainty, can attract FDI if there's stable ER because it reduces uncertainties. Disadvantage is that there's government intervention, requires government reserves and bonds, so the opportunity cost on other things they could have been used for reduces the country's ability to use monetary policy changes in order to affect the economy. So that's all for this video. If you did not understand something, feel free to put it in the chat. I'll definitely reply to you. Thank you for watching, and I'll see you in the next video. Till then, like, share, and subscribe, and ta-da!